Hi, this is Stuart Weems, and thanks for listening to the Investopoly podcast. My goal is to give you simple, easy to understand insights, strategies and tips to help you master the game of building wealth. In this episode, I'd like to talk about the 3 common mistakes that investors make. The first mistake that a lot of investors make, I think, is they don't think about risk first. Instead, they get seduced into thinking about the possible returns that they could achieve and sometimes don't even think about all the things that might go wrong. So what would you prefer? Would you prefer to invest in an asset that has a 90% chance of giving you a 7 or 8% compounding return? Or would you like to potentially invest in an asset that has, say, a 30% chance of achieving a 15% compounding return? Well, I can tell you that I would go to the former first. That is, I'd rather accept a lower return for a much higher chance of achieving better outcomes. And that's something exactly that seasoned and successful investors do. They first think about their downside, and they only invest in short things. The second mistake that people make is I think they think too short a term. If you're going to invest in an asset, let's say it's a property or share, and you're going to hold that asset for the next 10 or 20 years, for example, you'd want to make sure that you're going to get rewarded for that investment of time. Because there's one thing, you can always make money back, but you can never get time back again. So if you're going to make an investment and it's a long-term investment, you better make sure that it's really going to work. And at the end of the day, the immutable law of investing is the quality of your assets will determine your outcomes. You can't invest in low-quality assets and expect high-quality returns. So, if you're going to obsess about anything, obsess about quality. The last of the top 3 common mistakes is that people don't consider how tax effective their investments are. Now, don't get me wrong, it doesn't mean you should invest in assets for their tax benefits. What I'm suggesting is the type of assets that you invest in need to be tax effective. So if you're just starting out and building wealth, what you really want is most of your return in capital growth rather than income. Because when you're working, you don't really want more income because that means you'll just pay more tax. Whereas with capital growth, we don't pay tax on it until we sell the asset. Therefore, until we sell it, we get to reinvest our return tax-free. So we want that compounding nature of growth. It's different if we're retired. We probably want more income and less capital growth because when we're retired, we don't have any employment income and we don't need to worry so much about sort of tax benefits. If you get the tax consequences of your assets correct, it means you can keep more of the returns in your pocket as opposed to sharing them with the ATO. So what can you do to avoid making these 3 mistakes? Well, firstly, think long term. Ask yourself, what can you do today or invest in today so that in 10, 20, 30 years you'll be financially stronger? Don't worry about the next 1 or 2 years. Number 2, obsess about quality. If you're going to get anything right, get the quality of your assets right. Whether it's shares, property, bonds or anything else, quality assets produce quality returns, and that's an immutable law of investing. Number 3, invest in assets that are appropriate for your age and stage of life. If you're young or younger and building wealth, you really want more capital growth, so invest in assets that provide most of their return in capital growth. Property is one of those. If you're nearing retirement, then you start tilting your asset base towards income at that stage, not when you're starting out. And lastly, get independent advice. Seek financial advice from someone that doesn't have a vested interest in the advice outcome. That is, they've got nothing to sell you. I hope that helps. Bye for now.